In the Telegram, I was saying I was watching GBP, JPY. You already had your first deviation, aka your tap 2, and you're forming your tap 3. I'm going over it. I'm gonna explain it. It hit a target. It was an 8 RR trade. It was absolutely insane. Very nice Forex trade. Alright. But first, I will delete everything because this is more an in-depth, longer video, and I will go over the context first. Alright. I will take you through the whole trade process. So I will delete everything, and this is gonna be a longer video. I will first build some context, and then we will go over the low time frame trade, because what are we doing here? You formed a Wyckoff accumulation. You had your range from low to high, and you reached the target right there. Here's your first deviation, you have your second deviation, aka your tap 3, and there was your target hit. Alright, when we go higher, you see your supply right there. It's a very high time frame supply. And you see, while you were grinding up here, you were leaving a lot of liquidity behind. Did you take this low? No, you didn't. So this is going to be liquidity as well. So this makes price able to go lower. But this is all liquidity as well. Look at all those highs. Why is this liquidity? Because you make higher highs, and all these lows are stacking up on each other, right? Because if this low was taken out by this low, then this is not liquidity anymore. This has taken the liquidity already, but now it's just leaving liquidity behind. All right, so that's the context. Right here, you felt big inefficiency. You took liquidity of this point, I can see, and you took liquidity of this point afterwards. And right now you're forming a new range. And of course, this was first a range from high to low. Yes. But then you draw your range from low to high because you have a Wyckoff target. This is your Wyckoff target of the long right here. And this is your whole range. So this has your deviation right there and a deviation right there. And that is going to be your whole range. For now, I'm only going to use this low time frame range. Lower time frame is still high time frame. And I'm going to draw it from high to low. Why from high to low? Because on a high time frame, you make a higher high. Because this is no structure on a higher time frame. You see here, you make your structure is going high to here, you make a higher low and you make a higher high. That's your structure, so you draw from high to low. All right, let's go in the lower time frame, because what do we see here? You see your tap 1, you see your tap 2 as well. So you're gonna connect the dots. And is this your tap 3? It's not your tap 3, it's gonna be extreme liquidity, because this is your first move up before going down. This is a higher time frame range, guys, and you don't want your extreme liquidity to be this close to the higher time frame range. You want it to take time. So this liquidity is gonna be taken by that point, because when we zoom in, we can see it literally took that extreme liquidity of that point. So amazing to see. Then you can indicate, hey, maybe a reversal is coming. All right, let's go on the lower time frame, and you can see as well what I explained on the higher time frame happens on the lower time frame as well. This low is not taken out by that low. If this low was taken out by that low, it will be that liquidity is taken, but that's not the case. Then this liquidity will be taken. I will draw a line right here, and this has a less good return to zone. All right. This range has a very nice range inefficiency as well, because when I draw a range volume profile, you see that this is a big gap. All right, price will blast through if this goes lower. Very nice to see. On the lower time frame, you see some taps right there. All right, so let's go back in time, and let's because I shared this right there, and this is the context you're in. All right. You can see when I draw my volume profile as well, again, you can see you're rejecting from the volume area high of the higher time frame volume area range. So I draw my volume area from the higher time frame range, not from this point, not from the range we are gonna discuss, but from the higher time frame, because higher time frame overrules lower time frame. All right, let's go into the lower time frame range we were trading, because we came into some supply, and let's see which supply that is. You already see the wick supply I explained, but I explained in a previous video. Yes, wicks are supply as well, but you came into some 2 hour supply. This was your last candle up, before going down, leaving the inefficiency. And let's go on the lower time frame, because you have to see right now, this is a range in the range, of course, and you draw your range from what? From high to low, because you make a higher low, because this is your structure. You go higher, make a higher low, you go higher, make a higher low. So you draw your range from high to low. All right, let's go on the lower time frame and let's see where our tap 3 can be, because do we have some supply creation after our second tap? And yes, we have this last candle up before going down, leaving inefficiency. It's always better and always nicer to have a wick like this. Your wick is more perfect to look. Yeah, because now your last bullish candle goes higher than the downwards candle. When it looks like this, it's less good of a supply. All right. You put your alert there and wait for price to go there. It often accumulates before going higher. This was not a trade I would take, but it can happen as well. And let's play it, because it went lower, so the accumulation was not something to trade. And eventually you're coming into that supply POI, and you take your time, which is very, very nice, because now you have time displacement between tap 2 and tap 3. It's less nice when you form your tap 3 right here. It's only okay when you form your tap 3 right here, when the return to zone is incredible, but that was not the case. All right, good. We were forming some supply right there. This is your last candle up before going down. You see why this is better supply, because you have that wick. All right, 30-minute, nothing, but you see this wick is your 30 minutes, is your 15-minute supply. That's why wick supply is always also supply. And let's see if we come into that point. Yes, we come into the point. All right, very nice. But was there a break of structure? Because I saw it after that tap. I saw it after this supply mitigation, and this would be your break of structure. But we never broke structure, because when you see right here, we were going higher, and we were going even higher, and we took out this high, so we can delete the supply. But we never broke structure, because your last structure break was here. You never broke it, so you just went higher. And what you can see here is absolutely amazing. Oh, I forgot something to say, because your first valid entry would be right here. I cannot lie, because your first valid entry would be right here. This is valid, and you think, hey, I had to take an L to take a W, but that's not true. Why? Can you see it already? Because this had a big demand zone right there, a big important demand zone right there. And you have to be very careful when there's a break of structure and a demand zone right below it. Let's see if it was backed by the volume profile. Break was in the volume profile, so the volume profile is very nice, but the volume profile of this range is not the nice, because you preferably want a volume profile which has the biggest volume in the middle and the EQ, and then go lower. All right, but it was not backed by the volume profile, but it still was a very important demand level. So would I have traded it? Absolutely not. Would I have waited for the 50-minute supply to be mitigated to maybe trade it? Yes, for sure, because then you have supply creation right there. And when you go on the lower time frame, you see this demand, and you see, hey, we can go up into this supply and then break structure. So we can go down. I would definitely gonna wait for a retest to enter to go lower, but you never had a break of structure. So you went higher, you didn't break structure, you went higher, you didn't break structure, it wasn't a valid entry, you went higher, you didn't break structure, so there wasn't a valid entry. All right, now go over to the interesting part, because now things are getting interesting. All right, delete it, and you have a perfect return to zone right now, by the way, because these are all all lows stacking up on each other. All right, you draw your range from high to low, because you have a new range creation. You're leaving liquidity behind, taking time in the range, and you have a new range creation. So you have a Wyckoff inside of a Wyckoff. All right, let's see where our tap 3 is gonna be. Yeah, our tap 3. I'm for real. This is the most perfect entry you're gonna get, because it was just beautiful. Are you gonna take this 2-minute supply? No, you're not. Why you're not? Because this time displacement is this isn't even time displacement. This is nothing. All right, let's play it. And you see we're going higher. Let's play it a bit more. You see where we're going higher. Hey, what are we doing? We are deviating our tab 1, which I always want to see. Not many people are talking about it, but you deviate that tab 1, all right, with your tab 3, which is always almost necessary, but I don't trade it every time with a model 2. It depends on how strong the demand of supply is, but it's almost necessary. All right, can you now neglect this step 2? You kind of can. On a higher time frame you can. On a lower time frame it's still a valid tab 2, but on a higher time frame it doesn't look good. This just looks like an uptrend. Let's see if it looks good when I invert it, and then you can see all those lows, because they're still lows, stacking up on each other. All right, this is an incredible return to zone. Deviating the tab 1, let's extend this range a little bit. Then we don't have that line. Going on a lower time frame, and we see now it's even more clear that we are neglecting, we are not using that second tap, because price made a big deviation. The second tap on a higher time frame, because this deviation takes its time, shows that this is not valid tab 2 on a higher time frame. You know, you don't have structure down, you don't have 2 candles down. So this is going to be 1 deviation of this range. Price goes back inside the range. When you have an incredible return to zone like this, the time spent back inside the range matters less. All right, write this down, because this is important. This is important to remember for your following trade. When it is necessary to go back inside the range, but the time it takes inside the range matters less when a return to zone is incredible. All right, and you're still trading this trade with a higher time frame in mind, of course, because this is just gonna refine your entry, but of course you're only trading the higher time frame. Let's go back in time. Not back in time, let's go forward, because now you can see, hey, what is happening here? Where is your tab 3 POI gonna be? Let's extend it. You have your 1, you still have your 2 on the lower time frame, as I said. You have your 3. It goes back inside the range, not perfectly inside the range, but it does go back inside the range. And I mean what I explained right there. That it goes back inside the range and goes higher. So now it's still valid. It maybe looks a bit weird. It's still valid. Where is our tab 3 POI gonna be? And I hope it's working right now, because this is your first move up before going down. It's a very low time frame. It's actually only valid on the even lower time frame, but this is so obvious that this is going to be your extreme liquidity, because you have your first move up before going down. All right, this is going to be your extreme liquidity. Boom. And let's see if we tap it, because at the replay it didn't grab it, but let's see if it's gonna grab it right now. No, it didn't grab it on the replay, but it definitely got the mitigation. It's so weird. It's so weird, because I was already backtesting it, but it did grab that point. But because when I go in real time, you can see it did grab it, but in a replay it didn't. So believe me if I say it did grab this point. So let's draw it for the culture. There it is. I don't know why it didn't grab it in a replay, but it was looking like this. You were seeing the exhaustion right here, the exhaustion coming into that extreme liquidity point, and there you broke structure right here. This is going to be your structure break. This is your market structure. Boom, because you were making a higher low right there. You were making a higher low. You were making a higher high. So if you break this structure, you're going down. All right, and this means a rotation down all the way to this range low. Yes, guys. Yeah, I was gonna say you see it mitigated. It grabbed the liquidity right there, but it's not. So let's play it. Let's fucking play it, because this is gonna be your entry right here when we break structure in a minute. Boom. Is this a structure break? Not really. We have to go in 1 minute, because in 1 minute it was valid structure. Did you break structure here? No. Did you break structure here? No. It was still a wick. Did you break structure here? Yes, you had a close. Your entry is right there. Boom. Stop goes above this high. Not above this high, but above this high, because this already grabbed the extreme liquidity. So you're short from here, and what makes this trade wonderful is that you could de-risk it very, very quick. Because at first I had my de-risked TP right there. So my de-risked TP was right there. I had some text right there as well, like de-risked TP. But the thing was, when you didn't took out that range low, you went higher, you mitigated this supply zone, and you went lower. So what can you do? You can trail your stop loss to break even. You can literally trail your stop loss to this high, and now you're fully de-risked, and you don't have to take a partial TP. All right, your RR is still gonna be 7 because when we're going lower, you're targeting all the way to the range low, and your RR is 7. All right, you're fully de-risked, and now you're just gonna let the trade play out because it has no reason to go higher anymore. It is absolutely no reason because the supply is already mitigated. If it goes higher than that point, which can when it fills, then it will take all these highs and it will probably form a model 1 to go lower. So let's play it, and then you can see you're forming kind of around the bottom right there, which you don't have to stress about. All right, you have your 1, 2, 3, and you're forming around the bottom. You took liquidity and went lower. All right, stick to your fucking plan. Okay, good. There was the range low taken out, and there was your 7 RR trade, a 7 RR trade. Crazy. On a Friday in New York. It was amazing. I didn't go over the session points. I forgot it. So let's go over the session points. That's very, very important as well. All right, let's do the market session. Then you can see purple is Asia. So you have, this is your Asia high, and this I'm going too fast, and this is your Asia low. Your Asia high was taken out, your Asia low was not taken out. Perfect, because your Asia low is going to be a liquidity point for the market makers. All right, so pre-New York, we got the move down. London didn't take out those New York highs. That is not necessary. That's not the way I trade. And you still have some Asia lows left here as well at the range low. So there were 2 liquidity points. You had your Asia low right there, and you had your Asia low right there. All right, guys, I totally overcooked right here. Leave a like, leave a comment. I never asked for that, but on this video I do. Ask your questions in the comments. See you in the next video. Ciao, ciao.